So very briefly, we are going to look at the overview of risks and risk management. Then for young accountants, more importantly, I'll be looking at how to identify risk, especially in financial statements, how the concept of risk is important to accountants, then key risks that are associated with financial statements, common techniques for identification and assessment of risk. We'll look at risk management process, emerging risk in accounting, and so on. But then, what is risk? You know, at times there are so many things that we do, and then we don't know we are actually doing risk management. Okay, for instance, you have a task that you are supposed to do, and then that task you are looking at what are those things that will prevent me from accomplishing this task. Things like procrastination, things like maybe you don't even have the technical know-how of what to do. Okay, so some of these things you look at them and then you put in some measures, okay, to ensure that those tasks that you accomplish it. So basically, what is risk? Risk is anything that will stop you from achieving your objective or your goal. So that means that you have a goal. You know, doctor the other time was talking about goal setting. Yes, you have set a particular goal that you want to accomplish, and then you are looking at what are those things that will prevent me from achieving these goals. So as young accountant, I may just ask you this rhetorical question. Why did you decide to become an accountant? You know, because for me personally, I was actually in a science school. We were doing all sciences, and then, you know, those days I had the chance to meet the late M.K. Abiola, and I discovered he was a chartered accountant. So that was when sciences died. You know, I mean, naturally, I just wanted to be an accountant. Okay. Some people, they want to be an accountant because they want to make so much money. Some people, they want to be an accountant because accountants are very important. They are highly respected, and so on and so forth. But then in this profession, okay, there are landmines that you can come across that you need to be aware of. And then in risk managing, how do you risk manage these landmines to ensure that you come on tops and then you retire successfully without any issue? That is very, very important, you know, for us. And that's essentially what we are trying to look out for when we say we are trying to manage risk. Okay, are you sharing now? Okay, am I the one presenting? You don't have it yet.
We are sharing information. I'm not sure you can see.
You are sharing. Okay, let me stop sharing from here. Okay, so as I was saying, right, that is what risk is. So, but risk is not only about things that are bad. You also have opportunities. So we say that risk is duality. You look at what can prevent you and other opportunities that you can explore. So we have seen some situations that are very dire. For instance, if you look at the Atlantic City in Lagos, for instance, what's brought about that city, it was the threat from the Atlantic Ocean, where major part of Amadou Bello Way, you know, was under threat of being swept away. Okay, so we can say that was risk. But then there was an opportunity there where a city was created while trying to mitigate that risk. So risk is not always something bad. So, but when we see something that is seemingly bad, it's also an avenue for us as young accountants to begin to look at it that, okay, where is the opportunity around this risk? All right. How can I, while mitigating this risk, also make profit from it? So next slide, please. So basically, that is what concept of risk is. So when we say we are managing risk, we are saying that we are able to identify that something is going to prevent us from achieving our objective. Because if we can't identify it as a risk, then we will not put in place process to manage or, so to speak, mitigate that risk. Next slide, please. So, for accountants, how important is this concept of risk management? Personally, in your personal life, right, it is very important. Then, career-wise, for you to grow in your career, it's also very important. So, an accountant should not take decisions without data, without research, okay? So is it CBEX that our anchor was speaking about when we were starting? I mean, I don't expect an accountant to go and put money there because it doesn't just make financial sense, all right? And if you are a victim because it happened in Ibadan, anyways, I think you have learned a lesson, okay? So when you are dealing with projects or businesses that you don't understand, you shouldn't put your money there. You must understand the business. How is the cash flow going to be like? Okay, what is the cost? What's going to be the revenue? So that when you remove the revenue and the cost, you know what the profit is. And so when you understand what the profit is, and you now understand what returns the person is asking you that is going to give to you, you know that the returns is promising is even more than his profits. And you know that the business is not sustainable. That's personally. And then professionally also, you see that even career choices, you want to move from one company to another company. What research have you done? Have you looked at their financials? Do you know what the culture is like, you know, before you even make that career move? So it is very, very important. So risk management skills will help you to try to identify what can affect your own personal goals and aspiration in joining that other organization. But then if you don't have any job yet, you know, anywhere is better to start from. But if you have a job yet, you need to do risk management to be able to kind of know whether you are moving from fry pan to fire or you are moving from fire to fry pan. Then long-term sustainability. Risk management also enables you to assess and manage risks that could affect your organization in the long term. So I was working with a particular organization, and then I started seeing some red flags, right? As an accountant, I knew that what these guys were doing is not sustainable. I raised the issue, but because the power that be, of course, I was very young then, and my voice cannot even go far, all right? But then, how do I risk manage that situation? So if you cannot risk manage the organization, you can risk manage your own career. So I started looking for a job, and I got a job. I moved from that company in 2007. The company had problem in 2008. I hope you are understanding me. So for sustainability, whether for your own personal life or for your organization, you need to have understanding of what risk management is. Then crisis preparedness. Accountants equipped with risk management skills can better prepare for financial crisis. You know, unexpected events can happen. So that's why you will see that the prudence concept is coming in here, where you begin to speak about saving for the rainy day and so on and so forth. So this is also very germane. Then informed decision making. Yeah, I spoke earlier on. Razak, can you please mute? Thank you. So informed decision making, yeah, I've spoken to that you need to research. Your decisions have to be data driven. Next slide, please. So we have how these things are very important to us as an accountant. Then accuracy in financial reporting. I'm sure you must have heard about what we call internal control over financial reporting, okay? And that's also trying to ensure that there are no material misstatements in financial reports prepared by accountants, you know. And then when you have knowledge of risk management, you are also able to do fraud detection, ensure that your organization is not flouting regulatory requirements, and then you can also enhance your internal control in your organization. Next slide, please. Okay, so let's look at this financial statement. Yeah, so when you see a whole lot of what accountants are doing in the organization, the final output is financial statement. And this financial statement is very, very important now. And you see regulators are putting eye on, especially CFO. I pray that a lot of us we grow our career to become CFO. And CFOs need to sign this financial statement. And there is a reason for that. They don't have only corporate liability, they also have personal liability, you know, as long as they sign this financial report. So financial reports must not be fraud reading. There are so many things in the financial statement that if you are not careful, you may think, oh, it's nothing, but then it's actually fraud because someone is benefiting from it. You have accountants that may be under pressure, you know, from owners of the business, from managing directors, you know, to report in certain ways that are against standards. Okay, if they succumb to such pressure, they will actually be on their own. So risk management skills helps us to identify fraud, helps us to identify errors, and then when you have estimation issues, all right, maybe you want to do impairment or you want to make a provision and so on and so forth, you are able to do proper estimation that will not put you in trouble and also that will not put the organization in trouble. Then we have management biases. Like I said, you can be under pressure because maybe reported profit, maybe the MD has a percentage of it as a bonus and so on. So for such managing directors, they will want to, as much as possible, hide expenses, inflate revenue, as it were. So we also have complex financial instruments that can make estimation very difficult, especially when you are doing valuation or you are doing impairment. You may need to pay attention when you have risk management skills. Economic condition, yeah, the macroeconomic in the country can make it very difficult for business to want to report with integrity. And when that happens, they turn to accountants. And then when they turn to you as accountant, what will be your disposition to that? Then in that great internal control, weak internal control can expose financial statements to error or fraud, compromising its integrity. So let's look at common techniques that we can use to identify and assess this type of risk. Observation and critical stakeholder engagement is very important. This might not necessarily be for financial reporting, but generally in the organization, in your environment, you need to be observant. You need to engage. You can't be an isolated accountant. You can't be an island, okay? So you need to engage with stakeholders. You need to understand the business. You need to understand what is happening so that you are able to report accurately. You can use interviews and surveys, and then you can do environmental scanning. What's regulation saying? What do we have to comply with? What are the new standards, and so on and so forth. Then data analysis technique. All right. So at times you look at the reports you have prepared, or maybe you're an auditor, you are looking at an organization's report, for instance. You are looking at, okay, what's the standard deviation from the mean, depending on what you have maybe for previous years. It can help you when you do trend analysis, correlation analysis. It can help you to throw up spurious figures so that you can deep dive into those figures, ask necessary questions so that they don't put you in trouble. And then you can have quantitative risk assessment method where you have some stress testing for your organization. You are trying to look at, okay, this current position that you are now, for instance, can you stress test maybe your major revenue lines? If that's drop by 40%, how does that impact on your organization? You can build scenario and do scenario analysis to be sure that your company will continue. So that going concern, also for auditors, for instance, they may need to do this in order to, sign financial reports that, okay, they are of the opinion that that company is on a going concern basis. Then we also have qualitative risk assessment. This one you don't have maybe data, you don't have, but you have experts that can give their judgment and say, oh, if this risk crystallize, this will be the value of the impact. Or they can say that, oh, this type of risk is not likely to happen. Maybe the probability of it happening is maybe 10% or 5%. Or 50%. So that one is more of judgmental, which we call qualitative risk assessment. Okay, and so we also do benchmarking. Benchmarking may be that when you see a company, for instance, assuming you are doing audit of a company, and the company is saying they made a profit of 50 million naira. Okay, you want to now check the industry. What is prevalent in the industry for that type of company? What type of profit are they making, in order to know whether something is wrong or something is right? Then you can do predictive analysis also that can help us to bring out things that are not correct in financial statement through machine learning, time series analysis. And then when we are done with all this, we can then do our risk mapping. Risk mapping is simply saying that we are trying to prioritize our risk and then to know the one we need to pay more attention to. Okay, so if you are working in an environment, for instance, where you have they deal in cash, all right, they still collect revenue in cash, they take it to the bank, and so on and so forth. You know that the risk of privilege, the risk of cash missing, the risk of teaming and lading, and so on will be prevalent in such environment. And then you know that that one is an high risk issue. So basically, when we start with identification of risk, and then we can analyze the risk, and then we now evaluate it to see the top risks that we should focus on, because honestly, there will always be risk, but not all the risks have the same priority, because it's not all this risk that will affect us as professionals or that will affect our company. But what are those risks that we think that these ones are very critical? For instance, when you talk about compliance risk, for banks, for instance, compliance risk is very critical, because if you don't comply and they remove the license, you stop being a bank. And so all the other risk answers to that. Okay, credit risk is very germane, when you speak about banking and so on. So that's why you need to evaluate those risks, and then you prioritize them. Then after you've done that, you now look at how do we treat this risk. Okay, and after you have treated the risk, then you begin to monitor the treatment you have given to that risk to be sure that those treatments are effective. So we are going to be speaking about treatment of risk in the next slide. Next slide, please. Okay, so this is how to treat risk. Now, at times when you look at a risk, you can decide to accept the risk if the risk is probability of it happening is low, and then the impact of it, if it happens, is also low. So for instance, now let's say there is a young accountant here, for instance, and your salary is 1 million naira per month. All right. And someone says you should come and put 10,000 in CBEX. You can just 10,000. 10,000 out of 1 million. 1 million per month. Just 10,000 in one off. No walana. Let me put 10,000. You'll see that that risk is low because the impact on you is not really much. Okay, you can say, okay, just put 10,000. And you may not even decide to do any research. Just put 10,000. If it comes, fine. If it doesn't come, fine. Okay. Now, avoiding of risk. You avoid risk when the probability of it happening is very high and the impact is also very high. So let's say your salary is also 1 million, like we have said, and then you have just started work. Maybe you've just worked for 6 months. So all your salary is 6 million, but you have to get accommodation, you have to feed, you have to do everything. And they ask you to come and put 6 million in CBEX. You know that risk is very high. The probability that it will crash is very high. So that's the type of risk that you do what? You avoid. Then there is what we call risk transfer. So majorly risk transfer will be when you either outsource or you do insurance. You know, so when you do insurance, what you are trying to do is that, okay, most likely this is going to happen, but if it happens, let the insurance company bear that risk for me. So you pay a premium to insurance company. Insurance company also will collect premium from so many other people with the hope that the number of people that will come for claims will not be more than the total premium they have collected. So that is risk transfer. And the other one is to mitigate the risk. So when you are mitigating the risk, what are you doing? You are putting in place process, procedures, policies, and every other thing to ensure that the risk that you have identified, the probability of it happening is reduced, or that if it even happens, the impact is reduced. So that's what we mean by reducing risk or mitigating risk. So these are the 4 major ways of treating risk. So when we have treated our risk, like I said, we need to begin to monitor to be sure that this risk treatment is adequate. So let's look at emerging risks for accounting profession. Okay, so we can look at number 1. You know, accounting is not like it used to be. There are so many things that are happening, especially when it comes to technology. We are seeing a lot of changes. We are seeing a lot of advancement. Okay, so we have number 1, data breaches that may come as a result of this advancement in technology. You know, before you have your clients' financial information, you have them in paper, in what do you call it? Paper, in files, and so on and so forth. Now, if that information is missing, you will know because the physical file will not be there. All right. But currently, because we now have everything, software, we have in soft copy, and so on and so forth. If a client's data has been stolen, soft copy, you will still see your copy. So because you still have your copy, you may not even know. So you have data breaches that is very common. That's an emerging risk that accountants must necessarily have to begin to think of, okay, how do we protect our clients' information? How do we protect our organization's information from third parties or unauthorized. How do we prevent unauthorized access? We also have ransomware. Ransomware is even when they will just capture the information. They may encrypt your information and ask you to pay ransom before they can give you the code to decrypt it. We also have software vulnerabilities where you can have unpatched vulnerabilities explored by the guys in the black world, and then you may become sorry. I also have this remote work arrangement where, like this meeting that we are having now, it could be a management meeting, it could be any kind of meeting, it could be a client's meeting where sensitive information is being discussed. And maybe as you are seated, you are even listening to me, you are not using iPod, you are not using headset. So everybody around you, they are already hearing what you are saying. Okay, so just assume it's not a training. So you can see that data breaches, data privacy and every other issue around that, it's a concern because of the world that we live in currently. Then monitoring and oversight, there should be a way to ensure that when we are dealing with our clients' information, we are having Zoom meetings, Teams call, and every other thing, we have a way to ensure and sensitize our people not to expose our clients' information to people that are not supposed to be listening in, or eavesdropping on what we are discussing. Okay, next slide, please. Sorry, I forgot I wasn't the one sharing the slide. Okay, so we also have regulatory changes that can also bring about challenges for young accountants, which means that young accountants needs to be abreast of regulations, abreast of standards, and understand what is going on. In the accounting world, for instance, you have FRS standards. You have some of those standards, they still have voluntary adopters, and some of them compulsory adoption will happen maybe in so years. All of those information, we need to have them at the tip of our fingers so that we know how to adopt quickly, so that we are not caught napping. Then increased scrutiny from regulatory bodies may also increase scrutiny on financial reporting and auditing practices, leading to higher compliance costs and potential penalties for non-compliance. So we have, in fact, we have Federal Reporting Council of Nigeria now that, you normally submit your financial reports to them. They review this report. Every error, every mistake, they come with fines for your organization. This increases compliance costs. And again, at times, if you don't want these fines, you may be tempted to have to recruit a specialist or recruit more people in your finance department to begin to look at this, dotting the I's and crossing the T's to ensure that you don't fall flat. Then we have artificial intelligence and automation, which may also impact our career aspiration as young accountants. All right, we may need to also get skills around this AI, around this automation. Now, what it will do for us is that it will make our job easier, make our job faster. We are able to do more as accountants. So AI is not going to take our job. No, AI is only going to make our job easier in such a way that what 10 accountants should do, maybe one accountant or two accountants that are highly skilled in AI are able to do it. I hope you get the difference now. So there will always be accountants, but AI will be tools that will help us to do more than we naturally would have been able to do as individuals. Then biasing algorithms for the AI tools can also bring about challenges for accountants. Next slide, please. So other issues around this is the globalization and cross-border issues. So as an accountant, you may be fortunate to be working for a multinational where you have different laws in different organization. I mean, different laws in different countries where you're working, and then different uh, um, denomination, I mean, not denomination, different currency, and so on and so forth that you have to grapple with. Then you also have different culture. You know, in some culture, maybe they call it lobby. In some other culture, is brown envelope. What is really acceptable in this culture? What is not acceptable in that culture? You may always have to be abreast of this as a young accountant who wants to rule the world. Then we have ethical risks, all right, in this work that we do. Okay. And this one is more important for us as individual. Okay. For the job that we do as accountants, when you talk about fraud, experts will tell you that there's something they call fraud triangle. All right. So that fraud triangle, you have pressure, you have rationalization, and then you have opportunity. Now, as accountants, we are going to have opportunities. And most likely pressure will come from the board, from the CEO, even from our own individual lives and surroundings. But one thing that is very important and that ICANN is very strong on is integrity. We must ensure that our integrity is intact. And integrity is doing what you are going to do if nobody is looking at you, if nobody is going to find out. Okay, what is your stand? What are your values? Okay, and then so we must make up our mind, you know, even in our young or our early stage in life, to understand that this is what I will do and this is what I'm not going to do under any circumstances. Okay, and then begin to look at, okay, assuming I'm going to work for an organization that is compelling me to do this. Do you understand? That's, you are trying to identify the risk, because there will the likelihood that that pressure will come. Okay, that's the risk you are identifying. Okay, now, how is it going to affect you as an accountant? Okay, how is it going to affect your name, your family name, your career, your prospects in life? Then how do you hope to mitigate that risk, okay, when that time comes? Okay, so those are the things you need to begin to look at as a young accountant. So accountant may also encounter dilemmas when considering whether to report what is unethical or to just keep quiet. But the issue is that it's always a matter of time. Unless you can say that you did not see it or that you did not observe it, which may also bring to question your competence. Okay, it's a matter of time, it will come out. So I think it's always better to report and let it be written. So when you are reporting, you are not just verbalizing it, you are putting it down in black and white, which you are also saving in your OneDrive somewhere when the chips are down, so that you can say, see, this is what I have done. Next slide, please. So we have some risk management failures by accountants, and I'm certain that these cases are familiar to some of us. We have the Enron Corporation case, where Otto Anderson, that happens to be the fifth largest accounting consulting firm in the world, then went under just because they did not blow whistle. Okay, so you can only imagine how a business failed totally just because of one client. So at the end of this, can we say it was worth it? I don't think it was worth it. And when you look at WorldCom also, a telecommunication company, they were also inflating their assets, inflating their revenue, and then trying to push their company as a company that is profitable. But the outcome was that it was uncovered. It will always be uncovered, like I said, and it's always a matter of time. We also have the issue with KPMG and the silent auditor. You know, what happened where a particular partner that was reviewing a particular firm happened to know the management, and some of the things that should be disclosed were not disclosed. All right. So some of these failures are some of the things we can avoid if we propose in our heart at this early stage that we are not going to go that route. So these are examples of accountants that were jailed in Nigeria. Okay. Lukumanu Sani Waziri. Okay. He was an accountant in a teaching hospital. He was jailed for diverting 60 million. Now, like I said, there will always be opportunity. All right. There will always be opportunity as an accountant. You should have that at the back of our mind. But then, is it worth it? Ojo Ayomide, accounting undergraduate, was jailed for what? Internet fraud. It's not even an accountant yet. He has started Yahoo Yahoo. You can just imagine if you put this guy in charge of your business, what is going to happen. Then there's an ex-loot accountant also, who is an ex-loot accountant, sentenced to 15 years in prison, you know, because of what he did. We also have ex-Vanguard chief accountant, 40 million naira. Accountant General of the Federation too. You know him. Its case is not so far back. You know, it's also in trouble. So, ladies and gentlemen, accounting is a very good profession, and people are trusting that accountants will help them, you know, in doing what is right in their organization. Apart from owners of business, shareholders that are trusting us and believing in our capability to do the right thing, we also have regulators that are banking on us that will ensure strict compliance to regulation and standards. So the ball is in our court. Which side of the divide do we want to be? Those who go to jail, those who destroy the organization, or those who blow the whistle when they are supposed to blow the whistle. So thank you very much. That will be all from my end. I don't know if there are questions or reactions.